Howdy, everybody. Welcome back to 584 Vetoes. This is episode 3. We're the podcast that reminds you it can always get worse. Today, we're previewing next summer's tax reform fight because the TCJA is going to expire at the end of next year. But right now, we're recording this the night after election night 2024. Danny, some thoughts on last night?
I'm just furious that Grover Cleveland is now no longer the only non-consecutive president ever. It's very upsetting to me as a big fan of Grover Cleveland. Like, that was his, and the American people made a big mistake by taking that away from him.
I shout out to Troy Senik's great book, Man of Iron. You got to read it, about Grover Cleveland. I think you'll find that Cleveland and Trump are very, very different. Very different personally and politically.
They share this one thing in common.
This one thing. What do you think about Trump being the 45th and 47th president?
I think we just average it and say he's the 46th president.
I like that. There you go. All right. Well, you and I want to talk about the TCJA, the Trump tax cuts.
Tick-jaw.
I don't think that's going to catch on, but I mean, we can try. Because next year we're going to have this big tax reform fight. And so I think it's helpful to think about right now what we're actually going to be fighting over, what's going to expire, what could be temporarily expanded, especially because we now know that Republicans are going to be in control of the Senate. We don't know if they're going to have the House or not, but they are going to have the presidency. So in terms of leverage and, a balance of where things might fall, I don't think it looks like, Harris's plan to keep all of TCJA except for getting taxes on people earning above $400,000 going up is going to happen. So, Danny, I think, are you good with going through, I guess, the main parts of the TCJA and telling me, should we let this expire? Should we extend it temporarily? And what do you think that they're actually going to do? How about we do that?
Let's do it.
All right. So TCJA, one of the main parts, income tax changes, personal income tax changes. Before the TCJA, the tax brackets and the tax rates looked a little differently. TCJA was basically a tax cut across the board. We can talk about distributional effects, but the top rate went from 39.6% down to 37%. The lower income tax brackets, 10, 15, and 25% became 10, 12, and 22. The amount of money you had to earn to get taxed at those rates changed. If nothing happens, we will go back to the pre-TCJA world in 2026. So tell me, Danny, this is expensive. It's a little over $2 trillion over 10 years is how much more money the government would bring in if the tax rates went back up. Do you think, should we let this happen? Do you think it's going to happen? Do you think they'll maybe temporarily push things here?
So I think the answer to all of the questions when it comes to whether or not it's permanent or not is it will always be temporary, right? The nature of the voting math is you need 60 votes in the Senate to enact a permanent tax reduction. So everything will have to be done through reconciliation, and essentially the rules of reconciliation say the Senate doesn't get to you can't filibuster a certain budget bills that are considered reconciliation bills, but the limits on that are it can't add to the deficit after year 10. Mm-hmm. So anything they do is going to have to be within 10 years deficit neutral.
Okay.
And so the reality is there's no way you're going to get any of these things pushed through without doing that. So unless there's some grand compromise where you get some Democrats on board with changing the parts of the tax code, it's all temporary.
So how did they get the TCJA passed when it cost, what was it, $1.5 trillion what the CBO scored over 10 years?
Because we're having that debate right now again, because in 2017, you go 10 years out and you say, yep, and come 2026, they essentially ran out of the reconciliation window, and they ended it a year early. And I guess some of the logic of it was in order to get the corporate tax cuts permanent, they had to make some changes a little bit earlier. So regardless, the reason why we're having the debate now is because of it. And in some ways, like we often quibble on the spending side that, we have so much of our budget is permanent spending. And I think you can make somewhat of a similar case here that it's not a bad thing that every 10 years we have to have a debate over what our tax code should look like. Now, I mean, you can make an argument that it's bad for businesses. It's bad for people trying to make long-term investment choices because they don't know what their rates are going to be in the future. And so there is that element to it that providing people certainty is really useful. And I think even if you just look at the market today, you see people like certainty, people like knowing what their future looks like, and then they can make investments according to that, right?
I think
So
a new president every 4 years or a new election every 4 years that dictates truly the arc or the direction of tax policy and regulation policy is more of an upset of uncertainty than a 10-year tax plan, right?
I mean, potentially. I mean, everyone knew what their taxes were going to be all 4 years of Biden, right? So that wasn't something that went into people's calculus in 2020. But there were maybe some on the margin, some of the expirations that were coming out early. But yeah, I mean, overall, I think there is just the nature of democracy is there's going to be some uncertainty with this every 4 years, and that's unavoidable. With the tax code, we faced long term budget shortfalls, that massive rising deficits, and lawmakers at one point or another are going to have to make some very hard decisions between spending and spending cuts and tax increases. And so it's good that there at least is some element where Congress there are points in time where Congress has to actually address this and say, well, what do we want the tax code to look like? So
Yeah.
not completely a bad thing that these are going to all be temporary. Regarding your specific question on the tax rates, the tax rate reductions weren't the big part of TCJA, right? These were very small reductions compared to like what was being pitched in 2016, right? There were candidates in 2016 saying the top rate should go down to 28%. Instead, it went from 39.6 down to 37%.
Right.
So
28 was
just
the
the
86
yeah.
tax reform. Was that the top 86 tax reform?
Yeah, and
Something like that.
that was 28 came from the 86 tax reform, and it didn't last long. This was read my lips, no new taxes. Bush increased it, Bush increased it, and then of course Clinton pushed it up to 39.6, and then it's bounced up and down from 39.6 since then.
I want to back up actually and give some quick context because there is a lot going on here, and I was putting this together. It was nice to just refresh in my head of all the different parts. So, one in terms of big picture spending, in the next 10 years, CBO estimates that GDP is going to go up about 33%. I think $11 trillion up to 41 trillion from where it is now, and in the same amount of time, federal debt held by the public will go up $20 trillion. It'll go up 66%. And so when I say the TCJA personal income tax rate changes would bring in a little over $2 trillion over 10 years, federal debt is expected to go up by $20 trillion over
And
10
and to be
years.
clear, that 2.5 is already baked into that CBO number, right? That when we say that because all these are expiring, right? This is the baseline is assuming that we're going to get all this extra money in tax revenue.
Right. So, okay. So debt's going to go up $20 trillion in 10 years. If we don't let
Don't.
this expire, it's going to go up $22 trillion in 10 years,
hmm
is
Yeah,
the way
and
to
that's
think about it.
going to be true for all the different parts of TICJA.
TikTok. Oh God, I don't. You've made me start saying it. All right, so we're going to talk standard deduction, personal exemption, the other parts that we're going over: child tax credit, the AMT, state and local tax deduction, the mortgage interest deduction, business income pass through, corporate tax rate, which is permanent, but I want to discuss costs on that a little bit, expensing for businesses, and the estate and gift tax.
Hey,
So that's
spoiler alert. Make them listen to the whole thing, and then it's too late for them to turn it off. If you tell them ahead of time what we're talking about, then
I need to
they've
see
already
the
tuned out.
whole puzzle when I put together a puzzle. I need to see the picture so that I can build from there. I think. Does it make sense to talk about the standard deduction, personal exemption, and the child tax credit together?
No, it does not, Thomas, because
No,
the increased standard deduction is a great thing.
no, I know
So
that, but the personal deduction. Okay, well, I'll explain why. So the standard deduction, personal exemption, beforehand, right in the before times, you got a smaller standard deduction. What was it, about $6,500, $6,500 if you were single, $13,000 if you were married. Basically, this first amount of this money is you're not going to tax on it whatsoever. We're just not counting it against your taxable income, and then you got a personal exemption for each person in your household, including yourself, your spouse, any dependents, that also bumped that amount up of basically like money you've earned that we're just not going to tax whatsoever. Personal exemption was a little over $4,000 a person. And so we changed that where we got rid of the personal exemption in the TCGA and increased the standard deduction, basically about doubled it. And the difference here, I think the big thing for that we've called out is that the number of people who then itemize. So instead of just saying, okay, listen, forget about what I've donated to charity, paid in state taxes, property taxes, I'm just going to take this standard deduction and make my tax return a lot easier to compute. That used to be not as true. More people said, all right, I paid higher state taxes, I can deduct more. And then we got rid of all that, increased the standard deduction. And what percent of people don't itemize anymore, Danny? What was the I mean,
Under
roughly?
TCJA, it's below 10% now.
Stop with TICJA.
Under the TCJA, under the 2017 tax law,
Yeah.
fewer than or less than 10% of of tax filers actually itemize. Now, I mean, I think you're actually understating how great the expanded standard deduction was as like a term of a tax law, and that it didn't benefit high income earners at all. If
Right.
you itemize before, and say you
That's how
itemize
you lower your tax rate
say you
or your
itemize thirty
taxes paid.
thousand dollars, right? You have your state and local tax deductions, you have your mortgage interest or whatever, and then all of a sudden they just said, "Oh, your standard deduction is now 30,000." Well, then you are no better off than you were before just through the increase in the standard deduction. So it was people who already claimed the standard deduction were better off, and people with smaller itemizing. And then also on top of that, as you said, like it simplified the code, right? All of a sudden we didn't need to itemize as much, and also that kind of like reduces some of the politics of it's really hard to get rid of any one tax deduction, right? I mean, we see this with state and local already, and we see this with mortgage interest and everything else. But it's easier to get rid of these things if you only have fewer than 10% of filers actually claiming them. So it was a simplifying effort. It was maybe a political easier to fix the code in the long run, and it was also something that distributionally looked pretty good. It benefited low income filers. It didn't really benefit high income filers. And then the other thing to think about with the personal exemption does have a phase out, and so it doesn't really go to the high income folks. But even then, you get your personal exemption plus you could itemize under the old system. And so for people earning like say $300,000 a year or whatever, that was a good tax system for them. They got a bigger tax break. Where now all of a sudden it was, oh, that all gets baked into your standard deduction. If you're already itemizing, you're not going to get much value out of it, and you might be paying more in taxes because you don't get the personal exemption. Now the child tax credit complicates that, because the child tax credit. Would you like to introduce that one as
Uh,
the bane of
uh
my existence? I hate
well,
the
hang
child
on.
tax credit.
Some number
Sorry. Yes.
context. I think getting so CBO scored all of these things. If we extend them for the next 10 years, if we extend this standard deduction personal exemption change and keep it so it's just a higher standard deduction, I think the net cost they're estimating is about $500 billion over 10 years. So it does cost some money in terms of lost revenue. My question to you, Danny, would you prefer to keep the higher standard deduction, even though it's going to cost $500 billion over 10 years, maybe to keep
Yeah, I
going?
mean this is sort of a no-brainer. I mean, you can play around with the other tax rates to make it so it doesn't cost, you can
That's the
make it
thing. It's
deficit
there.
neutral or
There is
whatever,
an
but
endogeneity here of what the tax
it's
rates and
a
brackets
it
are, right?
it's one of the more probably outside of the corporate tax cuts side of things. This was probably my favorite part of TCGA. It was a no-brainer in terms of it reduced taxes for people, looked good distributionally, and simplified the tax code. It's a good piece of tax law that achieves all the things that the left would probably want to achieve too. So actually, I think this is one where if Kamala had won, we would still be getting the standard deduction increase. The only thing that might have come back is there's all these phase outs where like even like your or I mean, yeah, there's opportunities to sort of limit how much the standard deduction's worth. Dave Camp had an idea way back when that would really kind of eat into it. And so there are opportunities to even make it distributionally look even better. But anything you do on that front ultimately means higher tax rates, and you probably want to avoid that.
Dave Camp, an old House Ways and Means chairman, also my congressman from my home district, and the guy who sponsored me to be a congressional page. Good dude, good guy.
I believe
He had,
he's been referred to as a rhino a few times over the last few months.
I
So,
think every
but who
Republican,
isn't at this point?
yeah, absolutely is. Yeah, I think previous vice presidents have been called rhinos. All right, child tax credit. So beforehand, the child tax credit kind of interacted with the personal exemption a little bit. The child tax credit was $1,000. You have a kid, each kid you get $1,000 tax credit. There's some complications on refundable or deductible tax credit I don't want to get into. The TCJA, again, we got rid of the personal exemption, so you no longer got to get more personal exemptions based on how many children you had, many dependents, and so instead they doubled the child tax credit, and then there were you know during the COVID years and throwing money at everyone, we had temporary bump ups and it went back down. But if the TCJA goes away, if we let everything expire, child tax credit drops from $2,000 to $1,000. Reduce the deficit by $735 billion over 10 years. Danny, you have some kids?
As
What?
as a person with 2 children,
Mhm.
I'm their self-interest comes into this, but in the to the credit of the child tax credit, um, the best part of the child tax credit was the fact that because it replaced the personal exemption, it didn't give a bigger benefit to high income earners. So you can think of any tax deduction or the personal exemption. Ultimately, the tax savings from that is a function of whatever your tax rate is. If you have a higher tax rate and you reduce your taxable income by $1,000, that's worth more to you than someone that has a low tax rate.
Which is not how we want to design the system, right?
Potentially. I mean, yeah. I mean, I think ultimately, if we take a step back and say, what do we want our tax code to look like? We want a simple tax code, and we want a tax code that raises sufficient revenue to fund the essential services of government, and we want it to be as pro growth as possible. And the pro growth part means you want to have as low rates as possible with a very broad base to make sure people don't have an incentive to avoid paying their taxes, and also don't have much of an incentive to change their economic behavior in ways that undermine growth.
And I have to
Uh,
say that the implicit in that is that, well, high income people are probably going to do pretty well in that system, right?
I mean, you can tax high income people a lot and just not at a high rate, right? And so you can figure out ways to broaden the base to make it really hard for them to avoid paying taxes. But at high rates are ultimately going to be reducing economic growth. Um, but with the child tax credit, the problem I have with it is sort of the problem with a lot of our tax code is so much of our tax code is geared really just towards reducing income taxes for middle class filers as much as possible.
Yeah.
And what that ultimately means is it's higher rates on everyone. And so your these child tax credits are great for when I file my taxes, but generally they're not something that generates a pro growth tax policy.
True.
They're just cost a lot of money, and it ultimately means that somewhere else we have to have higher tax rates, or we're going to have higher tax rates in the future because of things like this.
Yeah.
And so you can make a much stronger case that if you think it's really important that we help out lower income families, like find ways to target assistance directly to them. Don't give upper middle class taxpayers a big child tax credit. And to be clear, that there is like a phase out beginning at $400,000 of the existing child tax credit. That from $400,000 to $440,000 of taxable income, your whole child tax credit phases out, which actually can create very high tax rates. Where all of a sudden, if you say you have 2 kids, you're at $420,000. For that $20,000, you're paying $2,000 more in taxes because you earned an extra $20,000. And so you tack that on to all the other taxes you're paying, and you can get your marginal tax rate up to 50-60% very easily.
We need to do an episode on why implicit tax rates are the same as explicit tax rates and how differently they pay. That's one of the ones where high income people are going to pay a lot in an implicit tax rate, where normally it's low income people pay higher implicit as opposed to explicit
Yeah.
tax
Now,
rates.
now I would point out to you that like we're concerned about people's marginal tax rate because we think it could affect their behavior. On the margin, do you have someone that's earning 400,000 that says, "Well, maybe I'm not going to go take that extra job because $20,000 extra, I lose my $2,000 child tax credit." Like, I'm gonna stay on the sideline, maybe. But there's not that many people that hit it. These little small pickups of the people with really high marginal tax rates. It's almost always oddities in the tax codes. And if you're talking about someone with $400,000, they're doing very well, but I bet they still have a mortgage. I bet they, are saving for their kids' college education, all of those things. They're probably not going to work less. And so their labor elasticity is probably pretty low.
I want to
So
see
we
the
shouldn't be that
graph of
concerned.
elasticities based on income with respect to various
Hmm.
programs and tax. That's a
Yeah. Yeah.
long-term project for us to build, Danny.
I mean, anecdotally, if my tax rate's really high, I probably actually work more because I have a mortgage and I have 2 kids to feed. So the substitution effects is very small there, I'd say.
Yeah, yeah. So
Mhm.
last thing on this child tax credit, you were saying, it's a kind of a giveaway for maybe higher middle class income earners, and it messes with tax rates. We're talking about income taxes, which half of Americans don't pay, and so there's this weird thing of where
Half of
half
half of
of
American households don't pay.
households,
Yeah.
but it's this weird thing of where if you start giving tax breaks to people even in the middle-ish or lower parts of taxpayers, uh, distributionally across the United States of all households, you could start benefiting high-income people without giving any benefit to low-income people because there's no taxes that they're already paying to help benefit them.
Yeah, I mean, unless you make all these things refundable, which
That's right,
is essentially what we've done, right?
and really
So,
expensive.
yeah, I mean, the bottom 20 quintile, the bottom 20%, the bottom quintile of U.S. households in 2021, 2022 had a negative tax rate of like minus 20% or something like that. So you can make these things look very nice distributionally as if you just, write big checks to low income
if
people as
you
part of
write
your
big
tax
checks.
plan.
All right. Next part that is going to be up for grabs, the alternative minimum tax. This is something I admit I don't think that much about. The AMT.
You should,
Um,
Thomas. You
I
should.
know, I know, we're getting there, but
Got some teeth.
it does have some teeth. So basically, give me a quick summary, and then I can provide
Yeah,
some
so the,
numbers
the
here.
AMT is a very old tax law that when it started, it was they looked around, they saw some really high income people earning, certainly in the top 1% who had very small tax bills, and said we have to do something to make sure they're paying their fair share. So they wrote this law.
Fair share, huh? What's the fair
Yeah,
share, Danny?
well, and so they wrote this law, and I mean, to some extent, it was, well, we're just going to take away some of your ability to itemize, right? You
Yeah.
you don't get a state and local tax deduction, you don't get certain business loss deductions, things like that. So it wasn't necessarily bad. They set the rates kind of high, but ironically, what's ended up happening is they didn't really index a lot of these to inflation, and at least initially, I think they are now. And so what's happened is more and more taxpayers pay them. So what it used to be something that would hit the top 1% actually now hits sort of upper middle income folks. If you're really high income, you're probably actually not paying the AMT because you're the top rate in the country's 39.6%. And so that's probably what you end up paying anyways, unless you have massive deduction somewhere. And then even then there's like other phase out provisions, P's the P's is it phases out your itemized deductions. So more than likely the AMT actually hits people that are like $300,000-$400,000 is kind of when it starts to bite if you're married. Um, and ultimately what it is, it says, okay, we're going to take away a lot of your deductions. You get this big huge exemption, which is effectively, you can think of it as almost like a big standard deduction that you get, or I mean it's a little different because you do have other deductions you get to still claim, like charitable deductions and mortgage interest. But ultimately the idea is it cuts down on those things. So it's I don't mind the AMT as much as probably some other conservatives do. Like I think
Well, that's because we think
the
we want to broaden the base a bit more. It's
and I
not.
think,
It's
yeah,
not
there's
hyper
an
focused on the
opportunity.
rich. Yeah.
Yeah,
Yeah.
there's an opportunity to use the AMT to do that. Now I think the rates are wrong, the exemption level's wrong, some of the design is incorrect on it, and then the other big part of this is that like you don't get to just file, you don't get to just pay the AMT. You have to do your taxes twice. You have to do it with the normal tax code, and then you have to do it again with the AMT, and then you have to see which system is the higher tax bill, and that's the number you pay. And so there's a question of like, oh, the kid is complicated tax code. Now the reality is like everyone has some sort of tax software they use now, and so is that actually complicating the code when your computer is doing the math for you? Probably not too much, but as someone who actually tries to do their own taxes on occasion, the AMT is annoying because you're kind of like, oh wait, am I going to pay the AMT? And this is something where the TCJA, they bumped up the exemption amount so much, made it so very few filers would actually pay it, and come 2026 it would go away. So I actually think the AMT is expensive, right? I think it's something like, if
Yeah.
you extend it 1.4 trillion dollars over 10 years,
Yeah.
it's a very expensive part. So I do wonder if there's actually an opportunity here maybe to think through how can we make the AMT be a little bit more, make more sense. So whether that's start changing the exemption levels, making sure it's hitting the people that lawmakers have sort of expected it to hit, and then also, I've always kind of had this dream of like, let people opt into the AMT and then they can't opt out. So give
For
people
how
the
for how long?
option forever. So like once you get into the AMT, you're essentially giving up your state and local tax deduction forever. You're giving up all those things. You've chosen to it, and then you only have to file your taxes that way. And so in the first few years, you're paying, you're going to be paying potentially more in taxes. And then over the long term, you get this, you'll be paying less in taxes if you're really high income or whatever. So there's like this weird, you simplify the tax code that way. It ultimately gets you closer to like a flat tax type system. But right now, where the
True.
rates are at, very few taxpayers would find it in their interest to do so.
Right. So right now there's an exemption amount, like your amount of income exempted, and then a phase out before you start paying the AMT. If we went post TCGA, if
Well,
we
the
had left
exemption phases out is
the
what
exemption phases
happens.
out.
So
Yes.
yeah,
Sorry.
so
That's what I mean.
essentially, it's the exemption is like a big standard deduction that you get, and then above certain levels, the exemption starts going away until you're just paying it. But again, if you have really high income, your marginal tax rate of 39.6% is probably going to dominate. The top AMT rate's 28%, so it's probably not going to bite for really high income earners. It's for people who are earning high six figures, doing very well, who really hate the AMT. It also kind of the people who are like, oh, I miss my salt. I want my salt back. And you're like, I don't think you realize that more than likely you're going to be paying the AMT and you're not going to get any
Even if it
salt
goes away,
anyways.
yeah.
Yeah, yeah.
So we'll talk about that. CBO estimate was if we allow this to expire and we have a higher, more, a more, what would you say, an AMT with more teeth, a couple million more taxpayers paying it, and like Danny said, it would raise $1.4 trillion over 10 years in revenue. And so, what do you think? Should we let it expire?
I think this is one where I would say there's probably ways to reform it where you're going to spend some money or you're going to reduce tax burdens by reforming it, but maybe don't just continue the way TCGA has set it up, just because it's really expensive and there's some merit in figuring out ways to simplify the tax code.
I like it.
But
Well,
that is sort of heresy among
I know.
uh, conservatives to some extent. So good, great thing nobody actually listens to this.
The SALT deduction, the state and local tax deduction, the
Hmm.
TCJA, it used to be for people, hey, I'm in a blue state. You're in a blue state, actually, but I have much higher tax rates here in California. You were able to deduct all of what you paid against your federal taxes for your state and local taxes. So personal income taxes and property taxes, and let's throw whatever else on there. And so you could get quite a large state tax bill, which would then lower your federal tax liability. The TCGA said we're going to cap that at $10,000, single or married, which is quite something. Uh, I thought it was. I mean, when we're designing an efficient tax code, I'd like to just get rid of salt deduction whatsoever. It does bias. I guess it makes it cheaper for blue states to raise taxes. It sort of softens the burden for their taxpayers compared to federal, and so there's this level of, well, is it fair? It's biasing high income, high earners in some states versus others. If TCGA expires, if this provision expires, we just go back to the old system where there is no cap. So I think a lot of high income people in blue states would love to see it. It cost $1.2 trillion over 10 years because you're going to have fewer federal taxes. That includes the mortgage interest deduction. What else to add here, Danny?
Um, yeah, so I think a few things. One, the case to make for salt. If I had to make a case on why salt's a good thing, and again, self interest takes over a little bit, and you're like, maybe it's not bad. But again, AMT is already going to take it away for a lot of folks who think they benefit
That's
from
a
it.
good question. Yeah,
But the one thing I would say is there is a case to be made if you want a pro growth tax policy, and you have some states with really high tax rates. This mitigates that to some extent, right? And so if you're just concerned about making sure the average total tax rate, which is what people should be caring about when they make economic decisions, the salt does keeping the salt in place, allowing people to deduct state and local income taxes, essentially lowers their effective tax rate. And so that's
true.
sort of the best argument I think you can make for it. There's also a case of like, yeah, federalism. If you want to have a low tax state, great, and if you want to have a state with a lot more things, like you can have that. And there's a philosophical question of whether or not the federal government should be subsidizing, but the federal government also subsidizes like low tax states like constantly, right? I mean, just through our
That's true.
progressive tax code, Californians pay more in taxes than low income states. So like in some cases, you can make it like a weird case of like this makes the salt deduction allowing it makes the code slightly less progressive, which is a funny argument to make. And this is one where like you get really strange bedfellows, right? Where you have conservatives in California saying, salt built America and we have to bring it back. And then you have, some, lefties in low income tax states who are like, what are you talking about? Like, this is like clearly a sop to the rich. Let's stop doing it. The part I hate about the existing TCGA rule is the fact that, as you said, it's the same $10,000 for married or single, which is just a huge penalty. So I think the easiest way to solve that is just to reduce it down to zero, and then that way there is no marriage penalty with it anymore. Short of that, maybe like cut it in half for single filers or something like that. I ultimately think this is one where Congress is going to say there's way too much money here. It's really hard distributionally. Anything they do to alleviate the salt is going to make the distribution tables look a whole lot worse because it benefits high income people. So ultimately, Congress isn't going to extend the salt, despite what Donald Trump had promised, despite what Californians and people in New Jersey and New York have said. It's going to. They might change it. They might double it for married filers, cut it in half for single filers, do something like that. But I'll be really surprised if we get all of the dessert of TCGA without any of the vegetables limiting our salt deduction. There was definitely an opportunity there to make some sort of like salt and pepper joke, or like, limiting our salt intake. But I can't
We'll
I
think
can't
about
get
we'll
there.
think of it in like 4 days. Next up, mortgage interest deduction. The cost of this is actually thrown in that earlier salt tax deduction
Hmm.
because they kind of stack. Very quickly, because it doesn't affect that many people. Beforehand, on the first $1 million that you borrowed against a home, the interest costs, whatever you paid, you got to deduct, and we lowered that to 700. The first $750,000 you borrow, whatever interest you're paying, that reduced your taxable income. My only note here is that this is not just a 25% difference between the two, because back then it was 4 or 5% interest rates on mortgages, and now it's 7%. And
Hmm.
so it's more than 25% in terms of cost. It is, I don't know, double that or so, something
Hmm.
along those lines. Um, Strong opinions on what should we bump this back up to 1 million?
We should get rid of the mortgage interest deduction entirely. It is a completely outrageous deduction that benefits homeowners at the expense of other people and ultimately drives up home prices. And there is no argument that you can tell me that
But
it
it
makes sense.
helps people buy homes, Daniel.
I mean, it helps wealthy people get deductions, right? But if you look at, if you're low income, particularly with the expanded standard deduction, the people benefiting from this are people who like are pretty high income. There's so hard to make an argument for it. I get people in California. I mean, I take advantage of the mortgage interest deduction. I'm an itemizer, and so I understand it from a pure self interest standpoint. But it pollutes the code. It drives it up, and I mean the housing folks who are. You go back. I'm gonna get in trouble for this one, but like I remember having conversations with people about the mortgage interest deduction in 2016 or 2015, and it was you had mortgage industry folks who pretended like 2006 and 2007 2008 never happened, that like the housing policy is perfect in America, we don't need to touch it, it's wonderful for everyone, it's what built this country. And it's so not true. It is a perfect example of how government, it's the Reagan quote, if something moves, tax it. If something keeps moving, or regulate it. If it stops moving, subsidize it. And this is government having driven up home prices through providing subsidies that benefit the rich.
So between the two options of keep it where it is right now with a lower 750
Hmm.
amount, or let it go back to the million, you say keep it where it
Well,
is.
that's
Like we'll
it's
leave that
slightly
option.
tricky one, because I do wonder if it creates some weird incentives, having these thresholds in here, because you can think, if and I candidly I actually forget exactly how it's worded, but if I owe $1 million on my house and then I pay it off a bunch and then I'm down to 750, can I refi and turn that fully into my tax deduction again? I
I
actually
honestly
don't
don't
know.
remember. The language is
But
the first
yeah,
whatever
but this is
amount
where
borrowed, but
any of these thresholds, you end up seeing games like this where it distorts economic behavior in ways that are bad.
it's a good question.
So I'm actually not quite sure. Now I think the reality is it doesn't affect many folks, and the people that are affecting, they live in uh California, they
The,
live,
the
I
the
mean,
people
Virginia,
who
right?
this affects are
Um,
literally people who are going to borrow, instead of $750,000, borrow 1 million for a house and get
yeah.
more of a deduction. That is literally the
Yeah.
only people it affects,
Yeah,
right?
and so it's a small group of folks. I don't think it actually saves that much money. There's a reason why CBO just kind of pulled this with salt, because
Yeah.
the difference isn't that great. I think we keep reducing the threshold down till it's 1 penny, and then but yeah, I can't stand the mortgage interest deduction as someone who has taken it every year. But now I have a what am I? I'm 7 years into my mortgage, and so the interest deduction is kind of
It's
falling. The
starting to fall.
amortization
Yeah.
schedules have caught up, and so now I'm like, oh, yeah, let's get rid of it. A few years ago, maybe I would have been more
Speaking
circumspect.
of tax policies that you also don't like, business income pass through. So this was a new 20%. Actually, maybe you do like it. A new 20% deduction on qualified business income. This is trying to equalize, because we lowered the corporate tax rate and then personal income taxes. We're trying to stop people from playing games of my income is my personal income versus I'm going to incorporate
You're
and
just
pay a
trying to get
corporate
me
tax
angry.
rate.
You're
Yeah,
just trying to get
yeah.
me angry with this argument.
Yeah, yeah. So
Uh, yeah.
it brings in some money if we get rid of it, right? Like it costs
Hmm.
almost $700 billion over 10 years if we extend it permanently, not permanently, but
Yeah.
over 10
So
years.
the income pass through, again, this is another one where self interest would say I should kind of support it. But it is an abomination in the tax code that we should get rid of post haste. Here's my issue with
How
it.
long
That
would your ideal tax code be, Danny?
Very short. Let's just go to Estonia and copy theirs.
Yeah.
Um, the QBI, qualified business income tax deduction, the argument for it was exactly as you described it, that, oh, we're giving corporations a tax cut, we need to give small business owners a tax cut. This is a rejecting the fact that the corporate income tax code created a much higher tax rate for most taxpayers than our pass-through tax rate. The pass-through tax rate prior to the QBI is just whatever your individual tax rate is. You take that income, and so that's why they call it pass-through. You pass through the profits to your individual tax return, and you pay that tax rate just as you would on your wage income or whatever. The corporate tax code back in 2017, the top rate was 35%. So you'd pay that, or the corporation would pay that, and they'd have 65 cents on the dollar. And then they would send you a dividend, and then you'd pay 20% on that. And so then you're paying 20% of 65% is 13%. So 65 minus 13, 52. That is how much you'd get. So $1 of profit a corporation made, you would get 52 cents on the dollar after taxes. And actually that's less than, maybe even less than that, because you got to throw in the net investment income taxes too. It was the tax rate on corporate earnings was so much higher than pass-through income. And so what TCJA was supposed to be doing, I'm going to go back to TCJA. Tom shakes his head. It was to level the playing field. And then Senator Johnson said, "Oh, we got to do something for small business owners." And so they did this 20%. And one of the big political economy side of it is that once you created a separate one of the arguments that conservatives used to make is it's really dangerous to carve out pass-through income from the individual tax code, because then it's a whole lot harder to justify low tax rates across the board, right? You can have a higher marginal tax rate if you say, well, small business owners aren't affected by it. And so we can have, instead of 39.6%, let's have 50%, and then let's just carve out pass-throughs. And, and you can say, well, it's because it's just easier to sell, right? Because then all of a sudden you're not hurting the small business owner who's running a shop down the street. You're just hitting that lawyer or doctor that, is earning excessive rents. The sort of the argument against that is, well, no, like, for one, keeping tax rates low across the board, it makes sense for other reasons. But beyond that, you give people bad incentives to start restructuring their income. All of a sudden, that lawyer and doctor says, maybe I can turn my profession more into, a bona fide business. And maybe I can take the consulting work I do and turn that into a business.
We want
And
to stop
so,
people from changing their economic behavior so that they can efficiently mess with their taxes.
yeah, so there, yeah, I mean,
Just go
tax
work and
avoidance
make your
becomes
money.
huge, right?
Right.
And
Yeah.
this is why when we say broaden the base, lower the rates, part of the reason why is because we know if you don't do that, you create huge incentives for avoidance. And so what the QBI actually ended up having to do, gave us this 20% deduction, but then it was like, well, we have to make sure doctors and lawyers aren't benefiting from it, or consultants, writing random economic papers about the public option don't benefit from it. Just a weird hypothetical. And so what they did is they were like, oh, we have these special rules that if you're one of these professions, then, we're going to carve it out and take it away from you a little bit quicker. And so at the very least, I don't know if you can get rid of it, QBI entirely, but I think you probably need to have some changes to it. I was talking to a tax person last week who suggested that, like, limit it to, how much you're actually expensing in terms of capital investments, things like that, or what your capital stocks, something like that, where whole lot harder for people writing, doing consulting work or things like that, where it's really just wage income, to turn their wage income into business income.
Okay.
And so there are ways probably to make it less costly, but just get rid of the whole thing and acknowledge the fact that once you account for capital gains and the corporate income taxes, the C Corps still pay a much higher rate than pass-throughs.
Okay. Speaking of expensing, this is another thing we did. It's mostly phased out, but TCJA said you can expense temporary full expensing. So normally a business is going to spend a bunch of money, have a capital improvement, and then they have to write it off over many, many years, a little bit at a time. TCJA said, no, go ahead, expense it all right now. That reduces their profit on the balance sheet, and so they pay less in taxes. It's slowly expired. The provision here would be to do a bit more of that, or to allow more first year expensing, a little bit more of I guess an accelerated depreciation schedule. Under $400 billion over 10 years to extend it. Yes or no?
Uh, yes, although I'm curious. So the 400 billion, does that include changes in interest deductibility? I actually don't know.
I don't
So,
recall.
full expensing is a good idea. The great thing about full expensing is it doesn't actually
It's pro growth.
benefit people who have already made investments. So it's very forward looking, right? If you say you only get this tax deduction if you buy a new machine or build a new factory or something like that, that encourages you to do those things. And
Mhm.
if you've already bought that machine, you don't get any tax benefit from it. So it encourages new investment, which is something that, yeah, drives up productivity, increases economic growth, improves wages, does all those good things. The issue is if you just do full expensing without fixing how we don't tax business, or how we allow businesses to deduct business interest, you can end up with negative tax rates where I get to borrow money to buy that new machine. I get to deduct that
Deduct
machine
that interest
fully. And then
cost.
in the
Yeah.
subsequent years, I get lower taxes because I get to deduct interest.
Mhm.
And so if you're going to have full expensing, you really need to pair it with some changes in our interest deductibility tax code to make sure people aren't able to just deduct business income across the board. And on the extreme version of this is if you do this well, you can generate essentially what's called a cash flow tax, where it's essentially becomes a consumption tax, where on marginal return, marginal investments, whatever return you get from that, you don't pay taxes on it because on the margin you should be buying that machine if it's going to deliver that much economic profit to you, whatever the cost of the machine is. And so it yields this good result, but it only works if you get rid of interest deductibility. And if you get rid of interest deductibility entirely, you can pay for a lot of this. Now, businesses would freak out, and you'll get
Yeah.
private equity folks who rely on borrowing to finance their operations very upset at you,
Right.
and small business owners
But
certainly
I like the
face
idea
issues
of
like
a
that.
more, a less interest focused
Yeah, I
tax
mean,
code,
right?
right?
We have it.
Equity financing, we'd like to rebalance a little toward there because you also reduce bigger debt problems because you're going
There,
to push
well, and
people to
there's
equity
less
finance.
risk involved, right? And equity financing, right? People bearing the risk of it are people who owns shares in your company. Where if you borrow money and you're a bondholder, bad things happen when a company goes under and you have a bunch of people that you owe
Left
money
holding the bag.
to. Where if you're an equity owner, you're kind of just like, ah, my investment has gone down 10%. I can try to sell the investment, but beyond that, there's nothing I can do. Where you're prone to runs and other things when you
And
use debt
bailouts, I would say.
finance and bailouts. Yeah. Hmm.
All right. Last one up here: estate and gift tax. They're very minor, not minor, but the TCJA I want to say almost double the amount of the estate tax
Hmm.
that you're not going to pay, death taxes on. Post TCJA would fall about in half. $166 billion over 10 years. So, we've been talking about half a trillion over 10 years for a lot of these provisions. Doesn't affect as many people as you think. Uh, I think the thing you're going to say, and the thing I would agree is get rid of the step up basis issue with estate taxes and gifts.
Don't put words in my mouth.
You agree
Um,
though, right? Get rid of the step up basis.
yeah, I mean, I think this so the step up basis is they did that when somebody dies, all of their
Their
gains that
unrealized
they
capital
haven't
gain
realized go
goes away.
away,
You
and
don't get
you
any of that
start at a
tax
new
revenue.
basis, and that made more sense back when it was a whole lot harder to figure out what basis was. If your company was 60, or if an equity, if you had an investment that was 67 years old, to try to track what the original basis was is very challenging. And so this is an opportunity to fix that. So yeah, I think you can make a case. Step up basis makes some sense. I think the concern with anything you do on the estate tax stuff is always you increase the incentive for avoidance. You increase the incentive for people to make different type of financial decisions later on in life that might not be in the economy's best interest. People start throwing money around, right? If you tell people we're going to tax all your money when you die, I'm going to go buy that $10,000 bottle of scotch and go and get some private plane rides and things like that, right? So you
Yeah.
do you encourage people to
I
consume
think I
more
think
at the
messing
end of
with
their
this
life,
is
right?
is you got to talk about what the estate tax limit should be. The step up basis be all for changing.
Yeah,
People
and
have
I
been
don't say
talking.
for all for changing. I think you got to be a little
Well,
circumspect there
sorry, I
because
want
of
to
the
pair it with
yeah,
couple
yeah.
things because people were upset
Hmm.
about
Yeah.
a lot of billionaires doing the
Hmm.
was it beg borrow die I can't remember
Yeah, and
exactly.
the idea is essentially I have a bunch of money. I'm going to borrow against that money, and then at death, I never pay my heirs never pay capital gains on any of these things. They can pay off my loans, and ultimately that money is never taxed.
Yeah, and so the
So
government
yeah,
never sees any of it.
there's a case to be made, and so yeah, I think if you say do step up basis, get rid of step up basis,
And
and
by
then
the way,
maybe it's yeah,
inflation
but
adjusted gains,
well,
maybe
I
in
mean,
there.
some of the issues are if you get rid of step up basis for everyone, you get a small business owner who all of a sudden will,
Ah, yes.
their kids inherit it, and then all of a sudden they're stuck with a big tax bill, right? So you need some rules where you have a certain amount of time to pay it, or if it's a and this is the problem with tax policy, right? The moment you come up with, you can always come up with exceptions. Where like, oh, gee, we don't want to, drive this small dry cleaner out of business because their kids had to liquidate at death, and even if you say you got to pay that over 10 years, you're like, well, that's could still be a very hard thing to do for someone. And then you're gonna say, well, okay, well, let's carve it out and make sure that as long as you keep that asset, you don't have to pay taxes on it, right? And so, so that I mean, the advantage of just like getting rid of step by basis, you just say, okay, well, the basis is the basis, and then however long you keep that for, you don't have to pay tax as an heir. You don't have to pay taxes for it ever, as long as you don't sell it. But there are it's a harder issue. But again, it's one of those ones where like conservatives get so eager to talk about the estate and gift tax, and sometimes I wonder politically if it's worth the capital we spend on it. I think it's bad to tax these things because ultimately it does distort incentives, and it's great for tax lawyers. But beyond that. I'm not quite sure it's worth the hassle.
Yeah. Other big thing of TCJA was a permanent change in the corporate tax rate. This is not up for discussion, and well, not discussion, but it's not going to expire or change tax rate. Corporate tax rate went from 35 to 21%. With Harris was proposing to bring it up to 28. That was probably going to be part of her tax plan, but that doesn't look like it'll happen. So it looks like corporate tax rate 21% for the foreseeable future.
Yeah, I mean that seems likely. Although I back in 2017 we had a senator who pushed for a slightly higher corporate tax rate in order to get the QBI, right? So I don't think it's beyond the pale that
Oh, okay. Okay, maybe maybe a percentage
some
point or
Republican
two
senator
might
might be
change.
like, oh, let's use the corporate income tax to pay for it. I think it's less likely at this point because you would be kind of messing with the first term Trump administration signature move. So not saying it's likely, but in a grand compromise, you could see changes to the corporate tax side that some corporations that are paying the statutory rate might be unhappy about.
Indeed. Indeed. All right. Well, that's the major things of the TCGA I wanted to talk about. Danny, we're running a little long, and so maybe I want to preview. Uh, man, I'm fascinated to see who the political appointees would be in a second Trump presidency. I mention this because one of the things that Elon Musk has said in this whole Department of Government Efficiency is he thinks he can cut $2 trillion from the federal budget. We spend $7 trillion a year, and I think in
Is
the
that
future,
annually the 2 trillion? Was
I
he clear on that?
he wasn't clear on it, which is a great question to follow up with him on. But I want to discuss in a future episode if people are interested. Like, how would you like? What's the maximum amount that you could truly cut from the federal budget on an annual basis? And I think we'll save that
Are the,
for another time.
I mean the answer to that depends on are you a dictator or not, right? Because I could easily cut 2 trillion from the budget,
Yes,
but
yes, but there is,
but the political restraints and the political constraints on that are rather significant.
yeah. All right, we'll skip a lot of other features, and we'll come back for another long episode another time. Danny, I do want to end on our veto of the week. We're up to our third Grover Cleveland veto. This one is not as clear, is not as flashy, I think, as the last one. Ready for this? This veto was about an act to quiet title of settlers on the Des Moines River in the state of Iowa and for other purposes. And I'll give the quick background here. Basically, there was the government back in the mid 1800s decided this is not public land. We're letting we're letting it go. And then there were various bills to try and recover this. Supreme Court cases deciding no, these are not public lands anymore. This is not government title. Some individuals in the Des Moines River in Iowa are harmed by this, and we're trying to help them out. This bill was trying to say, all right, let's open some of these cases back up and claw some of this land back and help these people out who are hurt. And so Grover Cleveland writes, this bill declares that certain lands, which nearly 24 years ago the United States entirely relinquished, are still public lands, and directs the Attorney General to begin suits to assert and protect the title of the United States in such lands. Basically says, listen, we've discussed this. We're not doing this. He made it clear that if Congress wanted to help settlers who faced genuine hardships, they should do so through direct compensation rather than reopening settled legal matters. And I told you before, this reminds me, it's not a cross subsidy argument. He's saying that this is not a cross subsidy that Congress was pushing for, but the generalization I think holds, and I'm waiting for you to tell me that I'm wrong. That if we want to help people, we don't do it indirectly through administrative law or the courts or any of those, and pass the burden on to everyone. We should identify who needs help. We should cut them a check, and we should put it on budget.
I'm not going to disagree with any of that. I will say I'm perturbed that you did not read the final line of his veto,
Go ahead, bring it.
where he says, if they are not public lands because the United States have conveyed them to others, the bill is subject to grave objections as an attempt to destroy vested rights and disturb interests which have long since become fixed. That's a good
That sounds
one.
like a
I
conservative
appreciate that.
message to me. This is the fixed
Yeah,
things. We're not
yeah.
going to overturn it.
I am shocked that the U.S. government was trying to take lands away from people where they had made an agreement that they could keep those lands. Shocked. In the history of all of my American history, I've never heard such an effort before. That's
More
just
things change.
an abomination.
All right, closing out
Yes.
episode 3. Hey, if you like what you hear, if you have questions for us, if you have ideas about how to cut $2 trillion from a $7 trillion a year budget, send us emails at feedback@584vetos.com. Find me on Twitter, Tom V Church. I'll pass it along to Danny. He's unreachable. Thanks a lot. Talk to you next time.
Bye.
The views and opinions expressed on 584 Vetoes are those of the authors at a particular moment in time and do not necessarily represent the views or opinions of their employers or their future selves.